Okay, we are going to start some of the more difficult material of the semester. And specifically, this is standard costs and variance analysis. Like I said, some of the most difficult material you're going to encounter this semester. Strongly suggest that you study this material regularly. As we've discussed in class, it's better to spend 20 minutes a day, 30 minutes a day, listening to lectures, reviewing problems, reading over your notes, rather than 3 hours a day of a test. This way you learn the material as opposed to memorize the material. Let me call up my, my notes here so we can talk about them. So what you're going to see here, let me stop sharing for this minute. I'm sorry. I'll go here, stop video, video settings. I'm not sure what you see here. Let me go back. Let me stop sharing. Apologies. Okay, so let me start sharing this material here. So what your the notes that you should see in front of you are standard cost and variance analysis. And the goal today is to review the Xonic beverage company illustration, which is within chapter 24 of your textbook. As I mentioned earlier, managerial accounting is about looking toward the future, specifically developing a plan for the upcoming year, putting it aside for a moment, and then executing the plan going forward. And then periodically, ideally on a monthly basis, there is a comparison between the plan and actual results. This is called a performance report. And the performance report is, again, a comparison between what should have happened and what actually happened. What should have happened, that is the budget flexed to the actual output. And that is probably one of the most important aspects of variance analysis, is because when we look at the standard is what should have happened using the budget assumptions, that is the flexible budget. Remember, we had a static budget, which was a plan based upon an estimated level of output. But then we learned how to prepare a flexible budget, and a flexible budget told us how the company should have performed at the actual level of output. When we do variance analysis, we're going to be looking at the standard. The standard is the flexible budget. It answers the question how the company should have performed at the actual level of output. So let's take a look at the Xonic beverage company illustration. And this begins in your textbook on page 24-7. I loaded up a series of pages from the textbook, highlighted and annotated. I loaded those up onto Sakai, which you may want to take a look at it. So this is the case study we're going to look at. To establish the standard cost of producing a product, it is necessary to establish standards for each manufacturing cost element: direct materials, direct labor, and manufacturing overhead. The standard for each element is derived from the standard price to be paid and the standard quantity to be used. The standards tell us what it should cost to make the product. all semester, I've asked you to think about quantity and price. We're going to develop quantity and price standards for this company. Then we're going to look at actual results, and we're going to calculate variances. To illustrate, we use an extended example. Xonic Beverage Company uses standard cost to measure performance at the production facility of its caffeinated energy drink. Xonic Tonic produces 1-gallon containers of concentrated syrup that it sells to coffee and smoothie shops and other retail outlets. 1-gallon containers. That's the output. The syrup is mixed with ice water or ice slush before serving. The potency of the beverage varies depending on the amount of concentrated syrup used. That's the product that Xonic Beverage makes. So we're going to go through this process. We're not going to spend a lot of time on it, but we're going to see how this company developed its standards for quantity and price. So in a few minutes, we're going to develop a standard cost card. And a standard cost card is a summary of quantity and price standards broken down by materials, labor, and overhead. Standards. They're also known as the budget assumptions. Remember, budgets are built on standards. Let's take a look. Direct materials. The direct materials price standard is the cost per finished unit of product of direct materials that should be incurred. This standard is based on the purchasing department's best estimate of the cost of raw materials. This is their price standard here in the yellow box. Purchase price, $2.70 per pound. Freight and receiving and handling. So their price standard is $3 per pound. That's what they should pay per pound. How much material should they use? That is the quantity standard. And we see here that they have determined that the required materials is 3.5 pounds. They allow for waste and spoilage. Their quantity standard is 4 pounds. It should take 4 pounds of material to make one of these gallons of concentrated syrup. Direct labor. The direct labor price is as follows. This is what they pay their direct labor employees. Hourly rate, cost of living allowance, payroll taxes, and fringe benefits. They should pay $15 per hour. That's their price assumption. We go back to 24.5. Direct labor, $15 an hour. Goes on to say here, how much time should it take? Direct labor, quantity variance, quantity standard, an hour and a half to produce it. They allow for some setup and downtime as well as rest periods. It should take 2 hours to make one of these products. Third component of product cost, as you well know, is manufacturing overhead. Let's read this. For manufacturing overhead, companies use a standard predetermined overhead rate in setting the standard. This overhead rate is determined by dividing budgeted overhead costs by an expected standard activity index. You remember the definition of a predetermined overhead rate. Total estimated manufacturing overhead dollars divided by total estimated activity base. As discussed in Chapter 17, many companies employ activity-based costing to allocate overhead costs. Because ABC uses multiple activity indices to allocate overhead costs, it results in a better correlation between activities and costs incurred than do other methods. As a result, the activity-based costing method can significantly improve the usefulness of standard costing for management decision-making. Xonic uses standard direct labor hours as an activity index. The company expects to produce 13,200 gallons of Xonic tonic during the year at normal capacity. So the estimated output is 13,200 gallons per year. That's important, per year. Goes on to say normal capacity is the average activity output that a company should experience over the long run. Since it takes 2 direct labor hours for each gallon, total standard direct labor hours are 26,400. So they just gave you the denominator value, the bottom number in calculating the predetermined overhead rate. I might note over here in the margin, I broke down the output by month. Remember, they said they estimate to produce 13,200 gallons per year. I've just calculated it on a per month basis. 13,200 gallons per year divided by 12 months. Their estimated output is 1,100 gallons per month. It goes on to say here, at normal capacity of 26,400 direct labor hours, overhead costs are budgeted to be $132,000. Of that amount, 79,200 variable, 52,800 fixed. So as you know from the semester, manufacturing overhead tends to be a mixed cost. Because it's a mixed cost, that means it has a variable piece and a fixed piece. This chart here on the screen is the calculation of the predetermined overhead rates. And what they did is they broke down the predetermined overhead rate between variable and fixed. Again, remember the formula. Estimated overhead dollars divided by estimated activity base. For the variable, estimated variable manufacturing overhead, 79,200, which comes from up here, they gave it to you, divided by the activity base, the predetermined overhead rate for variable, $3 per direct labor hour. They did the same thing for the fixed overhead. The total estimated fixed overhead is $52,800 divided by the activity base of 26.4. Predetermined overhead rate for fixed manufacturing overhead is $2. What's important to remember, when it comes to manufacturing overhead, the standard price is the predetermined overhead rate. So those are the standards. Direct materials, quantity and price, direct labor, quantity and price, and then manufacturing overhead. So what we can look at is the standard cost card. What does it cost to make 1 gallon of this syrup? What you're looking at here on the screen is the standard cost card, which is a summary of quantity and price assumptions broken down between direct materials, direct labor, variable manufacturing overhead, and fixed manufacturing overhead. What you can see here is direct materials. They determined it takes 4 pounds per unit, and it should cost $3 per pound. So the direct materials cost per unit or per gallon is $12. Direct labor, they said it should take 2 hours to make one of these things, and the labor rate is $15 per hour. Labor cost per gallon, $30. And what we've done here is we've broken down manufacturing overhead between variable and fixed. Again, manufacturing overhead is applied on the basis of direct labor hours, so we're going to still use the same 2 hours. The standard price is the predetermined overhead rate at $3. You get $6 in variable. The fixed manufacturing overhead, again, It should take 2 hours to make one of these gallons. The predetermined overhead rate, which is the standard price, is $2. It's $4 for fixed overhead. So they have determined that the manufacturing cost per unit or per gallon is $52. That's what it should take. That's what it should cost to make 1 gallon. Those are the standards. So now what we want to do is prepare a performance report. And what is a performance report? A comparison between what it should have cost and what it actually costs. What it should have cost, that's the flexible budget. Remember the flexible budget. We are using the same budget assumptions, the same quantity and price assumptions, but at the actual level of output, not the budgeted level of output. So the very first thing you need to figure out, and probably one of the most important things to look for, is the actual output. Analyzing and reporting variances. Once the one of the major management uses of standard cost was identify variances from standards. Variances are the differences between total actual costs and total standard cost. To illustrate, assume that in producing 1,000 gallons of Xonic tonic in the month of June, Xonic incurred the following costs. So they just told you the actual output. The actual output was 1,000 gallons. However, let's go back a little bit. When they prepared their budget, they estimated they were going to make 13,200 gallons per year, which is 1,100 gallons per month. That was their estimate, and they built the budget based upon the estimate. However, the actual output was only 1,000 gallons, 100 gallons less than the budget. So here are their actual costs. They actually paid out in the month of June $13,020 in materials, $31,000 in labor, variable and fixed overhead. They spent a total of $55,000. What should they have spent? They should have spent $52,000 to make those 1,000 gallons. How did we get the $52,000? Go back to the standard cost card. It should have cost $52 a gallon. The actual output was 1,000 gallons. They should have spent $52,000, but they actually spent $55,000. Now, yes, this is a performance report. It's a very preliminary performance report, and all it tells us is they spent $3,000 more than they should have. I asked the question, what was the cause? Did they spend too much money on direct materials? Well, if they spent too much money on direct materials, did they spend too much per pound? Or did they use too much material? Remember, there's 2 components to each one of these components of product cost. Direct materials has quantity and price. So I asked the question, did they spend too much money on direct materials? And if they did spend too much money on direct materials, did they use too much material, or did they pay too much per pound? Or maybe the variance is because of direct labor. Did they spend too much money on direct labor? If they did they pay too much per hour? Or did they use too many hours? We can't tell from this very preliminary variance analysis. All we know is they spent $3,000 more than they should have. The flexible budget, $52,000, actual cost $55,000. Where did they spend too much money? So we need a very detailed variance analysis, a very detailed performance report. So one of the things that we're going to look at is we're going to use this format here. So there's two methods to calculating these variances. The first one is by using the chart, which you see here. The second one is by using some formulas. As long as you calculate the variance, it doesn't make any difference. Let's look at this chart a little bit. On the left-hand side, we have our actual costs, actual quantity, and actual price. On the far right-hand side here, we have the standard information, standard cost, standard quantity. How much material should they have used to make that actual output? And then standard price, what should they have paid per pound? The difference between the actual and the standard is going to be called the spending variance or the overall variance. But we want to get even more specific and find out what happened. So we're going to break down these variances between a price variance and a quantity variance. That's where this middle column comes into play, where we have actual quantity times actual price. It's the format we're going to use for many of these variances. This worksheet here is simply a comparison. This is a calculation on the actual information, which you'll find embedded in the problem. What we're ultimately going to find out is that they actually used 4,200 pounds, and they actually paid $3.10 per pound. When it comes to direct labor, they actually used 2,100 hours, and they actually paid their employees $14.80. And here's some more actual information with regard to overhead. The standard, as we talked about before, the standard is what it should have cost at the actual level of output. It's the flexible budget. 1,000 gallons times $52 a gallon, $52,000. This is where you've seen it. This is the overall variances, $3,000 unfavorable. So let's take a look at some of the variances. We're going to look at direct materials, direct labor, variable overhead, and fixed overhead. Let's first look at direct materials. Using our chart, actual on the left-hand side, standard on the right-hand side. And what's very important here is the actual output. I wrote it in red, put a star next to it. Always need to be looking for the actual output because that's what the standard quantity is based on. Let's work with the standard cost first. Standard is SQ times SP. This is going to ask the question, how much material should they have used for the actual level of output? So you're going to start with the actual level of output, which is 1,000 gallons. They should have used 4 pounds per gallon. Again, that's from the standard cost card. Let's go back to the standard cost card. Let's remind ourselves of the standards. Here it is right here. Direct materials, 4 pounds, $3 per pound. That's what they should have spent. They should have used 4 pounds per unit. $3 per pound is what they should have paid. Go back to my variance analysis. Again, the actual output was 1,000 gallons. They should have used 4 pounds per gallon from the standard cost card. They should have used 4,000 pounds. Standard price, $3 per pound. They should have spent $12,000 on direct materials. What did they actually spend? See if I can, that's way too small. that's a little better. On the actual side, AQ times AP. What we know from the problem, and they told us this, is they actually used 4,200 pounds to make those 1,000 gallons, and they actually paid $3.10. 4,200 times 310, they actually spent $13,020. They should have spent $12,000. The difference between the actual and the standard is the spending variance of $1,020. Again, we're interested in more detail, so we're going to look at this middle column here, AQ times SP. Actual quantity, 4,200 pounds. Standard price, $3. We have a total in the middle here of $12,600. What does that tell us? The difference between the actual and this middle column, 13,020 less 12,600 is $420. That is my price variance. It's unfavorable price variance. What does that mean? They paid too much per pound. How? They actually paid $3.10 a pound. They should have paid $3 a pound. They spent 10 cents a pound too much, and they actually bought 4,200 pounds. 10 cents times 4,200 pounds, $420 unfavorable variance. In other words, here in the blue, they paid too much per pound. Part of the problem. Let's look over here. Difference between the middle column and the standard is our quantity variance. 12,600 minus 12,000, $600 unfavorable variance. It's a quantity variance. It speaks to the use of materials. They should have used 4,000 pounds. They actually used 4,200 pounds. They used 200 pounds too much. At $3 is $600 unfavorable variance. What does that mean? They used too much material. So as we look back at our overall variance, remember our overall variance was $3,000. 1,020 of it is from direct materials by paying too much per pound and using too much material. Let's look at direct labor. Let's start with the standard again. Remember, the actual output was 1,000 gallons. The standard cost card, let's go back. Let's revisit the standard cost card with regard to direct labor. It should have taken 2 hours, and they should have paid $15 per hour. Those are the standards. Here's the calculation of standard. 1,000 gallons was the actual output. 2 hours per gallon. They should have used 2,000 hours. At a standard price of $15 per hour, they should have spent $30,000 on direct labor. What did they actually spend? The problem told us in the textbook that they used 2,100 hours and they paid their employees $14.80. They spent $31,080 on labor. Overall variance, right? The difference between the standard and the actual, 1,080, too much, unfavorable. So again, of the $3,000 variance overall, another $1,000 of it is a result of direct labor. But what exactly caused it? So we go to this middle number here, AQ times SP. AQ, actual hours, 2,100. Standard price per hour, $15. The middle number is $31,500. The difference between the actual and this middle column is going to give us our rate variance, also known as our price variance, $420 favorable. Well, why is it favorable? Well, they should have paid them $15 an hour. They actually paid them $14.80 an hour. They paid them 20 cents less than a standard. So there was a savings there. Hence, favorable variance. Well, what about efficiency? How efficient were they? Did they use too much time or too little time? Let's take a look. They should have used 2,000 hours. It actually took them 2,100 hours. It took them 100 hours more than they should have used. 100 more hours at $15 an hour, $1,500 unfavorable. It took them too much time to make the product. What does that mean? That means that they were inefficient. They used too many hours. Let's look at variable overhead. Same chart. Left-hand side is actual, right-hand side is standard. Let's start with the actual this time. They actually paid $6,500. We don't need to know AQ and AP because they told us the actual total. What should they have spent? Well, again, the actual output was 1,000 gallons. It should have taken them 2 hours per unit. They should have used 2,000 hours. The predetermined overhead rate, the standard price for variable overhead was $3, which we calculated earlier and summarized in our standard cost card. They should have paid $6,000 in variable overhead. They actually paid $6,500. They spent $500 too much on variable overhead. How did that come about? We want to look at the middle column. Actual quantity times standard price. The actual hours come from our direct labor variance, 2,100 hours. The standard price is still the predetermined overhead rate at 3. Middle column is 6,300. You have a rate variance and an efficiency variance. I don't get too worked up about variable overhead. What's important to know here is that they were inefficient, but we know that, right? Took them 100 hours too much at $3, $300 unfavorable variance. Let's look at fixed manufacturing overhead. Now, this one's a little different. Please look carefully at the column headings. Actual, budget, and standard. So the actual was given to us in the problem at $4,400, but what was the budget? So we have to go back to the conversation about calculation of predetermined overhead rates. And what they gave us back here is they gave us the total estimated fixed overhead for the entire year at $52,800. So that is the budgeted number for the entire year. So when I look at my variance analysis, remember these are variances for the month of June. So we need to know what the budget was for the 1 month. So down here in the lower left-hand corner, I've got budgeted fixed manufacturing overhead. The budgeted annual number was $52,800. Divided by 12 months, the budgeted fixed overhead, $4,400. So the difference between the actual and the budget is the budget variance. And as you can see, that number is 0. What about this over here? The far right-hand side, again, is the standard, and we're good at calculating that number. The actual output was 1,000 gallons. It should have taken 2 hours per gallon. It should have used 2,000 hours times the standard price, which is the predetermined overhead rate which was calculated earlier at $2, they should have spent $4,000 on fixed overhead. Comparison to the budget, this is our volume variance. This variance here occurred only because of the difference in the volume, in the number of units. Let's think about it. The budget was based upon 1,100 units for the month. They actually produced only 1,000 gallons, 100 gallons less than the budget. So that volume variance is strictly the result of the difference in the volume. So we looked at this problem, the Xonic beverage company, Xonic tonic product problem, and we looked at 8 variances. It's not easy. This is not easy material. You're going to have to put a lot of time into it. We're going to see some additional problems as we go forward, but I need you to spend a bunch of time on this and get good with it. Thank you very much.